Hi, and welcome back to Pay Down Debt Solutions. My name is Jen, and on this channel, we teach you a faster, easier, less painful way to get yourself out of debt. Today, I want to go over with you guys home equity lines of credit and winning the debt war with a line of credit. Now, many of you out there have questions surrounding the home equities, and I just had another email the other day wanting to know what kind of questions you should be asking your bank when you go to look at using a home equity to eliminate your debt. So we're going to talk about that today. We're going to talk about, dispelling the fears around home equity lines and that using these lines of credit can unlock the power of a line of credit and accelerate debt destruction from using them. Okay, so we're going to dispel some myths around that. And then we are going to talk about what kind of questions you need to ask your loan officer when you go into a bank or a lending institution to, discuss getting an equity line of credit. And then we're going to get into a student scenario that they have the option of doing the first and second lien, because those are the two types of home equity lines of credit that we most often deal with. So we're going to discuss this, and we're going to discuss the options around that and show you why the home equity line is so incredibly powerful, because it is. Okay, so we know that there are many fears around the home equity line of credit, okay? And so, one of them is that, you may want to sell your house later. So if you want to sell your house, or if your house is up for sale, you cannot get a home equity line of credit, okay? So if your house is currently for sale, you cannot do that. If you think you want to sell your house in the future, people think that, well, I don't want to use my home equity or the equity that's in my home, because if I sell my house, then I'm not going to get anything for it. I'm not going to get anything back. Okay. So that's, one of the fears out there. Now, the other one is you've been told never to use a secured line for unsecured debt. And my answer to that is why? What are your options if not? So your options are sitting in the traditional banking system, working down debt that's taking you forever and costing you more. That's your option. So I absolutely 100% agree with using lines of credit to work down debt, because I know that you can work it down faster. Now, and as far as selling your house, well, if you put all your debt into your home and you go to sell it, it doesn't matter, right? Because if you have debt, you're going to have to pay off that debt anyway at some point. So you're either paying off the debt with the proceeds from selling your house, or you're rolling it into your line of credit, working it down faster. And maybe by the time you sell your house, you'll have a little bit more than you thought you had. Okay. So that's another one that, I don't worry about that. Now, again, though, if your house is for sale or you want to put up your house tomorrow, you can't really get a home equity line of credit. That would kind of be unethical, because you're not supposed to have your house for sale. All right. So you're not supposed to do that. However, if you have to do what you have to do, right, and get that home equity first, and then, start working down debt, and then you sell your house later because of unforeseen circumstances, or that's just something you want to do, or the market turns and it's going to be in a better position for you to do that, or you're going to be in a better position for you to do that, then by all means, you guys, you do you, right? You do you. So that's what we're all about on this channel, is allowing you guys the opportunity and the option to be you and do what is best for you. We don't tell you how to run your finances or what's the best way, because you guys know what the best way is. We're just giving you tools to work down your debt faster, okay? And through our experiences, because Dan and I have had multiple experiences with multiple debts, right? And so we learned velocity banking to work them down. What tools did we use? First, we started with a credit card. Then we went to the home equity line to just destroy our debt and get rid of it, all right? So if you don't have the ability to get a home equity, that's okay. You can still do it with credit cards. And you guys know this because I run credit card scenarios for you all the time. So let's get into the different types of home equity, the first lien and the second lien, what the differences are, and maybe some questions surrounding them, right? So we're going to ask and answer questions for you that you want to ask your lender, okay? You want to ask your lender these. So the two types of home equity lines of credit we use are the first lien and then the second lien. Now, the first lien is typically the lowest rate you're going to see on a home equity line of credit. Why is that? That is because the first lien is in the first lien position. So what does that mean, Jen? Okay, so what that means is currently, if you have a mortgage, your mortgage is in the first lien, right? The bank owns the house and you're paying them back, right? You're paying them back. You're borrowing the house from the bank until you pay it off. That's really what you're doing, okay? And so then that mortgage, that mortgage company is in the first lien position, right? Now, when you obtain a home equity, a first lien home equity, what happens is you're essentially buying out your mortgage with that line of credit, with that equity that's in the home. So you're taking your mortgage, you're absorbing it by that home equity, and then that becomes the first lien position. So that is why it is typically the lowest rate, because it replaces your mortgage. And it's the lowest rate because, again, there are no other liens above it. Okay, so it's safer for a bank to lend you money on that. So that is what we call the first lien position. And then, of course, we have the second lien position. Okay, the second lien position is typically the equity, the home equity that I talked to you guys about, because most of you have your mortgages, and then you have the ability to get a second lien on top of that. Maybe you can't absorb the entire mortgage using a first lien, so you use your second lien instead, okay? So the second position to the mortgage, that's why it's called a second lien, right? So you have your mortgage, and then you have that home equity on top of it. So it's in the second position to that mortgage, okay? And that's why the rate is going to be higher, okay? It's going to be higher. Now, it's still secured debt. So it's not quite as high as, say, a personal line of credit, but it is in the second lien position. So it's going to be a little bit higher than typically a mortgage, because those are loans anyway, and higher than that first lien home equity. All right, so there are some things that you want to make sure you're discussing with your bank, okay, when you are looking at home equities. So first of all, let's address this. Why do we want to use a home equity over a credit card? Well, because you will work down that debt faster, okay? You're going to work down that debt faster. You're going to work it down faster because you can put all of your income into that line of credit, that home equity line of credit, and you can run all of your expenses out. Why can you do that? Because those lines of credit, those home equity lines of credit, and typically most lines of credit, are connected to a checking account at a banking institution. Now, the most advantageous way to do this clearly would be to have your mortgage and your checking account in the same bank. If they're together in the same bank, that makes this one heck of a lot easier, and the transfers are easy peasy, okay? So they're either going to be hooked up as like an overdraft line, where when you have auto debits that are coming out of the checking account, those auto debits then will come out, and if there's nothing in the checking account, it pulls from that line of credit and covers those expenses, okay? And so then you can use your debit card, you have your ACHs coming out of your checking account, and that line of credit is, covering it for you, all right? So that can happen. Now, some of them don't work that way as an overdraft line, so you manually have to move money. If you manually have to move money, you just go into your credit or your banking, your online banking, and you just transfer money. It's very simple to do it that way, okay? All right, so the other thing I want to talk about with the first lien and second lien. So here, this goes along with questions to ask your bank too, okay? So your first lien or your second lien may come with an intro rate, okay? That is like a promo rate that they give you for maybe 6 months. It might be an intro rate for 3.99, 1.99 I've seen, and so they may run that for 6 months. They may also entice you to lock your interest rate, to lock a lower rate. Now, it's probably never going to lock at 1.99, but it might lock a certain percentage below prime, but it's never going to lock at 1.99%. I don't think. I mean, I could be wrong, but I doubt it. But they might entice you with a rate that you can, lock. Don't lose your rate. You guys want to lock it. Don't do that, because here's what happens. When you lock that rate, the debt that is on that locked rate then becomes a loan, right? It becomes a loan, it's amortized, and you then can't use the line the way you want to use it, or you can use the portion that isn't locked, but then you've got two buckets going on, and you don't have what we want to avoid, okay, which is a loan and a line. You want that line to stay revolving. So that would be one of the questions that you want to ask your loan officer, okay? Because they may say, hey, you're going to get a rate, we're going to lock that rate in for you. Ask them what exactly that means, because most of the time that's what it's going to be. They're going to turn it into a loan, okay? So that's what they're going to do. Now, So you want to definitely ask them about the rate. It does follow prime. Okay, so the rates are never exactly the same. They're going to be a percentage above prime. All right, so it is going to follow prime. So you need to know that. You also want to make sure that there is a checking account connected to it, or the ability to have a checking account connected to it. Now, if you have your checking account in one bank and you have your home equity line or in another bank, the problem is those don't communicate well at all. So if you transfer money, which you can do, the problem is it may take 3 days to hit your checking account. So you want them to be in the same bank if you can do that, because that makes the most sense. It is the most advantageous for you. Now, some lines of credit also come with a card, like a credit card, right? Attached to that line of credit, which you then can set everything up to be paid through that line. The only problem is you can't pay your mortgage through it, right? So you'd have to be transferring money across banks to then pay it out of that the checking account. So that's why I don't advocate for your line of credit, your home equity line of credit, and a checking account in a different banking institution. It just doesn't make sense at the end of the day. So really try. You might have to move your checking account if that's the case. Get a good rate, or you can get a great home equity line. Then you know what, you guys, pick up your checking account and move it. I do it all day long, to have the advantage of using a home equity line of credit to work down my debt. All right. It is the best way to work down debt. Okay. So you want to talk about fees too, find out what kind of fees. Now, the second lien home equities are pretty inexpensive. A lot of times it might be like $125. They're not much, maybe 500 tops. Of course, rates can change, so don't quote me on that, but that's pretty typical of what you're going to see. The first liens are going to be more. So you might see them up to like $4,000, right? But if you get a mortgage, that mortgage, those closing rates are going to be a heck of a lot higher. You're talking like 9, 10, 11, 20. You're going to see closing rates a lot higher. So the first liens are going to be a little bit more expensive for you because in a sense, you're buying down that rate too, okay? All right. So I want to go over why these are very powerful tools, okay? And I hinted at it before. Number one, obviously their average daily balance, just like a credit card, right? It's on an average daily balance. So as your balance drops, your interest is also dropping. Remember those amortized loans, they're fixed. That means that you're bleeding out interest in the beginning of those loans. And then as the loan goes by, you're paying less and less interest, okay? But you're going to pay a lot more in interest than you are on principal to begin with, in most cases when we're talking any equity type product, okay? Now, let's talk about the student scenario that we have here. So this was a couple that they're being eaten alive by their interest, and they wanted to do something about it. And lucky for them, they do have the ability to get a line of credit. Now, they did refinance their home, which they were kind of, mad at themselves for, but, water under the bridge, right? So they did refinance their home about a year, I think about a year 1.3 years ago. Okay, so they did do that. But now they're contemplating doing something different, right? Doing a first lien home equity. So we're going to show you what the two options for them could be, okay? So and what that might look like, and then the differences at the end of the day. So with this, we're going to talk about their mortgage, which is at $205,000 currently, okay? Rounded just to make it a little bit more simple for you guys. That rate right now is at a 6.5%. Now, their home appraises for $340,000. Their home appraisal came back and it was $340,000, a hair under that, but we're going to say $340,000 to make it simple. Now, depending on your state that you live in, okay, home equity lines of credit. First liens, typically they will go up to 90% loan to value, okay? Value of the home being the $340,000, all right? Now, the second liens are a lot of times up to 80% loan to value, okay? In some states, it doesn't matter whether it's first lien or second lien, they will only go up to 80 no matter what, okay? In Michigan, as far as I still understand it, we go up to 90% loan to value for a first lien, okay? So what does that mean? So if your home appraises, if their home, which we know appraises for $340,000, that means that at 90% loan to value, if they consider the first lien home equity, they're going to take that $340,000, they're going to multiply it by 90%, which gives them $306,000. They are going to then, to find out how much equity they have, subtract off what they owe, which is the 205. The 205K is what I have there, which equals the equity that's available to them for the first lien is 101. Okay. Now, if their mortgage is 205 though, they can roll it all together. Okay. They can roll it all together, and this then would then take over their mortgage. The first lien would take over their mortgage, meaning that it's going to be the 205 plus whatever debts they pay. Okay. So that's how that works. Now, the second lien at 80% loan to value, if that's the case, we know it appraises for 340. We're going to multiply that by 80%, which gives us 272. Then you subtract off the 205,000, and it leaves them with $67,000 that is available to them in equity. Okay. Now, that's riding on top of that mortgage though, right? Right. So we think about it this way. You've got the first lien takes over the mortgage. You've got the second lien. It sits on top of the mortgage. So you pay your mortgage and then you pay your home equity line of credit on top of that. All right. So if their income is $5,610, okay, so 5,610, and their total expenses are 5,360, that means they have $250 in cash flow, right? And I didn't write down cash flow. Shame on me. I will do that for you. All right. So this is cash flow, right? Okay. So their cash flow is 250. Now, their mortgage currently, like I said, is 205, right? 205,000. And the payment on that is 1,296. They have a car here that they are contemplating rolling into that, okay? Because they want to get rid of this big car payment. It would be nice to get that back, and it would be nice to do that so they could work down some debt. So they've had the car for 18 months. I believe it is a 60-month loan. So what is that, 5 years? And the balance is $22,098, okay? So that would mean that the $22,000 would have to be rolled into either the second lien or first lien, depending on what choice they make, okay? Now, they also have other debts out there. They've got a Citi card, the Freedom card, I think that's Chase Freedom, Capital One, and a personal loan out there. All right. So the Citi is at $93.80. It's $190 a month, 23%. It would take them 12 years and 1 month to pay that off traditionally. And it would cost them $19,873 if they continue on this schedule. Okay. So the Chase Freedom is at $4,916, and it's $120 a month, and it's at 24% interest rate, which means it will take them 7 years and 3 months, and it will cost them $5,453 in interest debt. Okay, so that is what it would cost them. Now we've got Capital One over here at $7,309, $201 to pay that back monthly. It's at 21%, and it's 4 years and 11 months to take care of that, and it will cost them $4,411. Last but not least, we have that personal loan. So that's on an amortized schedule now, isn't it? We've got a personal loan for $12,100, $300 a month. It's at 8.9%. It's a 48-month loan for 4 years. And it's at to pay that back is $2,325. So in total, what do their debts look like? So they owe $33,706 aside from their mortgage. Okay, so that's the debt that they have incurred. Their payments on that are $811 a month, so $811 monthly. Now, look at this. The interest that they will pay to term these out at the top end, 12 years, the lower end, 4 years, it will cost them $32,062, okay, in debt. Look at this. $33 is the balance of those debts. It will cost them $32,000 in interest. That is why we get out of the traditional banking system and we do something smarter. We do velocity banking, and we do it with home equities. Yes, we can do it with credit cards too. But in this case, we're using home equity, lines of credit. So what I'm going to do is I'm going to split these out for you, and I'm going to show you what it looks like, A, with a first lien, and B, if they choose a second lien. And here's the beauty. We give you guys choices, right? It's up to you to make those changes. But the greatest thing is, with velocity banking, you have a choice. You can choose to work it however you want. You are not stuck like you are in the traditional banking system. So give me a second. Let me erase some of this for you, and we will go over these two loans. Okay, so let's carry on with our scenario here. So in this situation, they have a choice. They can choose to use the first lien position, or they can choose to use the second lien position. So what makes more sense and what will they do? Okay, so that's a question here that we have. So let's take a look. Well, let's first go over the first lien position. So if they decide to take over that mortgage with a first lien home equity, okay, so gets rid of their mortgage, they would then have a first lien home equity. They would not anymore have a mortgage payment. The first lien becomes their mortgage payment. Okay, so we follow the rules of income in, expenses out. So no longer have a mortgage payment, and all of these debts here, right? The $33,706 gets added to that mortgage. Okay, so remember we start with 205 and we put in the 33,706, the 33,706 plus we're going to put in this car. We're going to put in the car loan. So that's 22,098. Okay, so when we do that, that means we start with a new balance of 260,804. Okay, so 260,804. So we do what we do, right? With Velocity Banking, we do what we teach, we do what we do, and we put our income in. So that drops our balance immediately, right? It drops it immediately to $255,194. But then our expenses have to come out, okay? So our expenses come out. So $267.78. Now, where do I get that? Where do I get our expenses? Well, we take our total expenses that we started with, the $53.60, okay? We are subtracting off the mortgage payment in this case because this mortgage payment will be gone. So we're subtracting off the mortgage payment. We are subtracting off the car payment, and we are subtracting off the $811. So what does that total? Okay, so if we do that, we're going to take the $53.60, which is our total expenses. We're going to subtract $1296. We're also going to subtract $575, and we're going to subtract the $811. So we get $2,678, $2,678. Okay, so that's our new expenses, right? So we have look at all this cash flow we've gained. We've gained $811 here. We've gained $1,296, and we've gained $575 in cash flow. How is that? How did we do that? Because we rolled it into our new mortgage, which is that first lien home equity. We rolled it all together. Now, we don't roll mortgages together on a fixed rate like that, right? Because we reset the clock. And are we resetting the clock? Yes, but no at the end of the day because of how we work it down, all right? They've already reset the clock once on themselves. They've already done that, all right? And they paid interest all over again. Now we've absorbed all of our debts that we're paying anyway. We're going to pay this $33,000 anyway. So we may as well make it work for us in the best way we have, the best way known to us through Velocity Banking. So that's what they've done here if they choose this option, okay? So now, like I said, their income comes in, drops them to the $2,555,194. Then our expenses come out. Now we have to calculate our interest. Well, our interest rate, and did I write those down for you guys? I sure didn't. Okay, so let me show you what the interest rates are. I apologize for that. Okay, so our first lien here, I'll just write it over here. It's 7.2%. Okay, so this is 7.2%. And then the second lien there, I believe, was 10.875. So this is 10.875%. Okay, sorry, my apologies. All right, so let's pick it back up. So now our income comes back onto that line of credit. Our interest comes back onto that line of credit and drops us to $259,419. How do we get this? How do we know what the 1547 is? That interest rate's important, right? It's important because we have to calculate this if we want to know our end result. And that is the fun of Velocity Banking, isn't it, you guys? Figuring out what the end result is and how much money you're going to save. So let's do that, okay? Now, we know we have to take our high balance, which is $260,804, all right? We're calculating our first month's interest. We take this $260,804, so $260,804, and we're going to add our low balance, high balance plus low balance, okay? $255,194, okay? That equals $515,998, okay? And then we divide that by 2 to get our average, so $257,999, all right? $257,999. But we now take the $257,999 and we're going to multiply it by 0.072, okay, which equals, what is that? 18,575. Sorry, I can't read backwards. All right, so it would be 18,000. But that 18,000, we're 575, we're going to divide by 12 because we only want 1 month, okay? Which means we get 1547. That is our first month of interest, is 1547. So what do we end up with? We end up with a balance of 259,419 after this month is done and all of our expenses have come back onto that home equity and our interest. So we're at 259,419. Here is where we stop and check. Is this 259,419 lower or higher than the 260,804? Well, it's lower, so this is working, right? We're running in the right direction. So now we're going to do this all over again for month 2. Our income comes in, drops us to the 253,809. Then we have to add back in our expenses. We add in our interest, which is lower here. Because remember, we are now taking this high balance plus this low balance, adding them together, dividing by 2, multiplying by 0.072, getting a number, that number, and then which is a year, and then dividing that by 12 to get another month, which is the 1,539. So we end up with $258,026, which is lower than the 259,419. So again, running in the right direction. This is working. We haven't had any unforeseen issues that have caused it to go back the other way, which again is what is beautiful about velocity banking. When shizzle happens, right? When stuff goes wrong, that's okay because we have the ability to have that padding, that power behind us, which is that line that revolves, okay? All right, so what does that look like then? Okay, if we're working with the first lien, that means that it will take to finish this off. Now remember, this is our mortgage too, our mortgage as well. It takes 125 months, which is 10.4 years, and it costs us $109,843 in interest. That is way more than this over here, isn't it? It is. But we've also taken care of our mortgage now, haven't we? And we're about to talk about the 30-year mortgage interest rate that they will pay over 30 years. And we've done it in 10, all right, for 109. Now, let's pause there. So here's the second lien position, right? So we are not absorbing our mortgage in the second lien. It rides on top of the mortgage that we're currently paying, right? So we have to pay this along with our mortgage. So that means we're taking our $33,000 plus our car loan, adding it together, because remember, our purchasing power was 67. So this fits inside easily that home equity line of credit, that second lien. So, oops, I just erased my 4. Sorry, guys. Okay, so 55,804, put in our income of 5610, drops us to 50,194. We add in our expenses. Wait. The expenses are different, aren't they? They're higher than they are over here. So why is that? Well, the reason would be because we're still paying our mortgage, right? We're still paying our mortgage on top of that. All right, so you have to add that mortgage back in. If you were, you would have to add it to this number, correct? Okay, so the mortgage we're paying separately. So our expenses are $39.74. Then our interest is $480. Well, it's a lot less, right? Because we don't have our mortgage inside of it. So again, same rules apply for interest, for calculating interest. You take your high balance, you add it to your low balance, you divide it by 2. You then multiply that by the 0.10875, okay, which is our interest rate. It's going to give you a year's worth of interest. You then divide that by 12 to get 1 month of interest, which is the 480, okay? So that's how we calculate it, again, just for, sake of understanding. So then that means that once we add this expenses in, once we add in the interest, we're at 54,648. That's what we end the month at. So is 54,648 higher or lower than the 55,804? Well, it is obviously lower. So this is working. We're going in the right direction. Again, we do it again for month 2. So then we end up, once we put our income in, at 49,38 plus the expenses plus the interest, right? And this time I calculated it right. I transferred it over correctly, so it's lower. All right, so 53,481 for month 2. Okay, so what do our end numbers look like? Well, let's take a look. So if we were to just take care of our debts here, the 33 plus the car, okay, what we end up with is 37 months, so 3.1 years to take care of, $55,804 in debt, okay, total debt. And that means that we spend $9,974 in interest, which still is a heck of a lot less than the $32,62. But remember, we would have to add in the car loan interest, which I didn't write that down. It's 2,000. Sorry, guys. It's 2,000. Let me see. That car loan interest was 2,129. So 2,129 is the interest on that. So I'll just write that in. 2,129. Okay, so that's what they would have left to pay on the car if they banked it out traditionally. All right, so $32,062. We spent $9,974, and we spent less time than it would take over here. Okay, so we saved a lot of money by putting it into a home equity line of credit. That's why we do it. We save time, we save money. Now, let's go back and revisit the first lien though. We know it takes us 10 years. We know it costs us $109,000 in interest. Okay, so it costs that. All right, so we'll get rid of this. And then we're going to look at what our mortgage was. Okay, so, or is currently, I should say, what their mortgage is currently. All right, so their mortgage would cost them, and it is costing them at this point, it's costing them it's costing them for 30 years, $261,466. You subtract off the $16,000 that they've already paid in that 1.3 years, which drops them to $2,444,918. Then when you subtract off the $109,843 that they will pay, that means that they're paying in interest on their total mortgage now, $135,075. It's that they've saved. So they've saved this money now. They've saved it. And 18 years of time. 18 years of time. So velocity banking, is it worth it? 100% it's worth it. Why do we do home equity lines of credit? Because you destroy your debt so much faster. I hope you guys have learned something today, and I hope you continue to follow us, and I will see you in the next video.